Yo, what's good, everybody? Okay, welcome to the video. I thought we'd just do a quick little video on Tattooed Chef and just look at some of the financials. I thought this would be a fun one to cover because honestly, on YouTube, I've seen there's been a fair bit of controversy surrounding this stock and just a lot of people talking about it and whether it be positive or negative. So let's just go ahead and review some financials and get an idea of, if this company is worth dipping your toes in or if there's just a little too much risk involved. Okay, so first of all, we'll go ahead and get just a brief look at revenue here. Grew from about 85 million to 148.4 million and then to 213 million in the year 2021. So, I mean, you can see that this is a company that is, in fact, growing, high revenue growth. So, obviously, at first glance, you can't deny that. But what catches my eye right away, just looking at briefly looking at their financials, is a really big one is when we talk gross profit. So if you follow me here, we have first of all, let me explain what gross profit is for anyone who doesn't understand. Gross profit is quite literally your revenue. So let's just use the 2021's numbers, for example. Gross profit is just your revenue minus the cost of goods sold. So gross profit is quite literally your overall revenue and how much it cost to produce that, the actual cost of goods sold. And so you'll get revenue minus cost of goods sold, and that's going to be your gross profit. So my area of concern where a red flag goes off here is, you have revenue increasing, but cost of goods sold, like the cost to make these goods and make everything happen, really increased a bunch. And then you can see gross profit really didn't go up that much between 2020 to 2021, yet your cost of goods sold really went up. I can already tell without even doing the math that this means that your gross profit margin is going to be a lot lower. But let's go ahead and work out the numbers. I actually have the little calculator up here. So let's go ahead and let's just start in year 2019. So your revenue was 84.9 million. And your gross profit was 13.185 million. So let's go ahead. And when you're looking at gross profit margin, that's just going to be your gross profit divided by revenue. And that'll give you a margin that represents what your gross profit looks like versus the revenue. So 13 let's just call it 2. I'm just rounding a little bit. I don't want to enter all the numbers. So 13.2 divided by, and let's just call it 85 million. So 85. And that's going to equal, okay, so that's about 15.5% gross profit margin. So 15.5% gross profit margin, or you could just call it gross margins. We'll clear that. So let's go up in the year 2020 then. Let's fast forward, where you can see the gross profit did increase. It increased a reasonable amount. So let's go ahead and see how that looks compared to 2019's year. So 21.68, and we'll divide that by your revenue for the year, which is 148. Fuck it, just round it to 5. Okay. Boom. So basically, that comes out to roughly 14, let's just call it 14.6%. So 2019's gross profit margin, or gross margins, was 15.5% here, Now it's dropped to 14.6% for 2020, but really that's still not that bad. That's a, you know, somewhat reasonable margin. And now let's see what 2021's year was for the gross profit margin. So we can do that by going 22.1 divided, and remember we're getting that from the gross profit here, and we want to divide it by the revenue for the same year. I don't know if I hit divide already. There we go. Divide by 213.43, and that equals... Okay, folks, so here's the problem. The gross profit margin now has dropped to 10.35. I'll be generous and call it 10.5. But still, it dropped to 10.5 or 10.5% for the year 2021. So you had 15.5 here, 14.6 here, and then it drops way off to 10.5%. So, the problem with that is pretty evident, especially when you consider, because that's a huge drop off. And I mean, like 10.5% gross profit margin, like that's terrible. Those are awful margins. And the company was shooting for basically when they were in this area here, maybe it was closer. No. I'd say they were in here. They were in 2020. And I remember reading that they released a statement saying, oh, we're shooting for 22% margins and we can get there. And now they're dropped way off to 10.5%. And now I read their last earnings report, and now they're guiding that it's going to be anywhere from 10 to 12% for the foreseeable future. And this had to do with overhead cost increasing, cost of food increasing, cost of, freight shipping increasing. I get it. Cost for everyone has gone up. Inflation happened. But, I mean, I don't care. As an investor, in terms of me looking at numbers, this just isn't good. This questions sustainability. And oh God, if these margins are this terrible, are they going to have to dilute more and more and more? And do take note, for those who aren't used to reading financials, when you've got your revenue here minus your cost of goods, which gives you your gross profit, this cost is just the cost of the actual goods sold as it sounds is what it is. That doesn't include the other overhead cost of the business, like operating expenses, for example. There are other, administrative costs. There are other costs to a business. So it's not just, oh, wow, my revenue was $213 million and my cost of goods sold was $191 million. So therefore my gross profit is $22 million, and there we go. That's the overall amount the company takes in. No. As you can see here, the operating income is negative almost $37 million. And that has to do with the fact that there are other costs associated with a business. And if you want to do the actual math on that, you're at $22 million on the gross profit here. But then other operating income or expenses and administrative costs as well puts it minus 60. So that's what ends up getting you to this negative practically $37 million. And that's just an operating income. And then if you just look at it overall, you see a negative trend. I mean, here operating income is a positive $6 million, and then it drops in 2020 to negative 9.9, almost negative 10 million. And then it dramatically drops to negative practically 37 million. So if you can't tell, I don't like what I'm seeing from this company so far in terms of the financials. And then you're, nail in the coffin is way down this way when you go ahead and look at their shares outstanding. So not only is this company not stabilizing financially and the margins are getting worse, but you also have shares outstanding down here which are increasing every year. Now, part of my understanding is I think dilution happened to a pretty large extent, especially in 2021, because I think they bought out like a factory or something so that they could increase production. So this stands to be seen what happens with shares outstanding if they keep having to dilute, because I think the majority of it may have happened because of acquisitions they made. However, they're burning cash. They're not making any money, and margins are getting worse, and overhead costs are increasing. So I'd imagine they're still going to have to dilute shareholders at some point again. And it may be in the year 2022 that they do it again. And another point I want to make is, people are willing to forgive everything that's happening down here that's a bad thing, like the terrible margins and them losing all this money and burning cash. They're willing to overlook that because they're like, wow, look at all the revenue growth. But I just want to make a point here and follow along with me here. Let's go ahead and calculate the growth from 2020 to 2021. You can just do that by dividing 2021 by 2020. So 213 divided by, let's just call it 148. Just trying to get rough numbers here. So let's round it up. Let's call it 44% revenue growth that they had. So we can say that from 2020 to 2021, through those years, they grew 44% year over year, which, I mean, that is really good growth. Yeah, I'm not going to deny that. So people will excuse all the bad things happening with the company because they have high revenue growth. But here's where the problem comes in terms of excusing a poor functioning company with revenue growth. Okay, so let's go ahead and take a look now at these shares outstanding and see how much you're getting diluted. And people will say, well, that's the cost of growing a business. Why does that matter? What are we talking about here? The reason this matters is because if your shares outstanding increases that much where the share dilution outpaces the revenue growth, well, it's as I just said. You're basically getting almost like a negative revenue growth. Okay, so let's just go ahead and do the math here. 82. Well, okay, you know what? We don't even need to do that. That's dumb. We can basically see what it's going to end up being. So essentially, if you do the math and calculate what the share dilution was versus revenue, it was over 100%. And you can see that. So quite literally, from 2020 to 2021, the share dilution was over 100%. And if we look at the previous year, let's see, the previous year was actually not as bad. So from 28 million to 40, that's a 42% increase. And then this growth did outpace that. But if you're looking at the last year, which was 2020 to 2021, this level of share dilution outpaced the revenue, which means you basically had negative revenue growth in the year 2021. Your revenue growth was 44% here, but your share dilution was over 100%. There is such a thing, and people choose to ignore it. It's called revenue per share. And that's how much revenue. It's a really simple ratio. It's as it sounds. It's quite literally, how much revenue are you getting per share? So you do the revenue for that year divided by shares outstanding. So let's do a hypothetical then. So let's say you had a revenue, which you did, of $213 million. Oh, come on, click, you stupid thing. and you divide that, because remember, it's revenue per share, and you divide that by your shares outstanding. And let's just say they didn't dilute you at all. And let's say they kept it at 40. They didn't dilute you at all. Your revenue per share that you get as an investor is 5.3 at that point. Okay, but because they diluted you, divided by 82, it's 2.59, practically half, and that makes sense as it doubled. So I hope this concept kind of displayed the fact that displayed by that ratio, your revenue per share was half of what it could have been because you were diluted over 100%. Your revenue per share was decreased because of this share dilution. And to further put this into perspective, your revenue per share right now, because of this level of share dilution, based on year 2021, is let's just round it up and call it 2.6 per share. So revenue is 2.6 per share. If we just go with the previous year, which was basically, let's just call it 148, and divide by your shares outstanding, which was ended up being 40. Boom. It was 3.7. So your revenue per share, the part of the revenue you get as an investor, was 3.7. So you as an investor, revenue per share got 3.7, and then you get diluted and it dropped to like 2.5 in the year 2021. You are getting ripped off. You're getting cheated as an investor when your share dilution outpaces the revenue growth. If this is all you had as a talking point for this company, revenue growth of 44%, guess what? It didn't mean anything because your share dilution outpaced your revenue growth by a long shot. And that's proved by the revenue per share ratio. Now, we could probably go on and on about this, but honestly, I mean, that's an overall kind of a just quick outlook on some of the most important financials you really should be looking at when it comes to a company like Tattooed Chef. Let me just put it this way. If your only talking point is that they grew 44% year over year, 2020 to 2021, that means absolutely nothing because your gross profit margins are dropping and your share dilution outpaced that revenue growth anyways, so it didn't mean anything. And all your other margins and your operating income are all getting worse and worse. By the way, might I say, I'm not here to bash them. I haven't looked into them super well. But just looking at the financials here, I can tell that this is a really bad story and not a very good stock to be part of or invested in. But I do have to say, I don't hate this company. I just don't like the valuation here. I don't like the look of the stock right now. When we look at it from a financial standpoint, I do not like this company or stock. That's better said. I do not like this company or stock at all from a financial standpoint, from a fundamental standpoint. In terms of their product, I've actually tried a few of them, and I do like some of the products. If you've never had a cauliflower pizza, try theirs. And if you have had one but not theirs, try theirs. They by far have the best cauliflower pizza out there. And I love their Buddha bowl. I love their acai bowls. I think I said that right. So, I mean, look. But here's the problem when it comes to bowls of this company. People who are bullish on Tattooed Chef, here's what they talk about. They talk about the revenue growth and ignore everything from here down. They ignore everything down here. They only look at revenue growth, and then they make the story sound good about how the products are great and the outreach and, oh my God, look at all the SKUs that we're getting into, and brrr. It's like, that's the problem. I can talk about how I like the products and still admit that fundamentally and financially this company looks awful to invest in right now. I like eating some of their products. I buy some of them on the regular, like the pizza. We get it from our local Sam's Club. You get 2 pizzas in a box, and it's like $12, so it's like 6 a pizza. But, I mean, cauliflowered pizzas tend to be pretty expensive anyways. You're trying to be healthier. But guess what? I mean, it's the best damn cauliflowered pizza I've ever eaten. I like their product. It's good. I've had a lot of their products, and they taste good. But I don't care. Like, you can't intertwine, ooh, I like the product. Although it is good to like a product that you're investing in. But you can't mix up, ooh, I like the product, and then start to excuse all the bad financials just because our revenue growth rate looked good. Okay, so recap. The growth is good, but past that, everything else sucks. Your gross profit margins are getting worse, as we went over earlier in the video. Operating income getting worse and worse. And guess what? Your share dilution, as of right now anyways, we'll have to see in the future if they stop that. But your share dilution is outpacing your revenue growth, and that's complete poop. You had negative revenue growth for the year 2021. That is terrible. Okay, y'all, that's all I've got for you on Tattooed Chef and just sort of a review of their financials. If you like Tattooed Chef stock or you're invested, please don't hate me. I'm just telling the facts as they are, so don't hate me too hard. Yeah, okay, that's it. All right, y'all. Bye-bye.